What if I told you there's an option in hard money lending where you could, as a borrower, build your loan payments into the loan so that you didn't have to make any loan payments while you were going through your fix and flip or building a new house? In this video, I'm going to explain how experienced investors use interest reserves to keep liquid, to maintain their liquidity, and to keep their projects moving forward through completion. Wait a second, Mike. I don't have to make a loan payment? No, interest reserves allow borrowers to bake loan payments into their loan. And it's huge for those who want to preserve their liquidity and just raise less capital or do more projects. The success of a fix and flip or a new construction project often comes down to borrower liquidity. Having the ability to preserve your liquidity as a borrower is going to increase the chances of success. And when you're dealing with a hard money loan, which oftentimes comes with higher interest rates, having the ability to build loan payments into the loan itself allows you to preserve your liquidity and to keep the project moving, to keep contractors working, to keep everything moving faster through. So just like I really like to focus on construction draws when I talk about fix and flip loans and new construction loans on my channel, because of how important it is to a borrower in getting through their project quickly, interest reserves allow borrowers to keep their liquidity on hand by not making the payments and to keep their project, I feel, moving faster and to rely less on the lender in terms of their draws and more on your own liquidity, which is always a better position to be in as a borrower. So hard money loans can be expensive. Interest rates can be high. So having the ability to build interest payments, loan payments into the loan can be a massive, massive game changer for borrowers, because oftentimes we're dealing with loans that will require $7,000 to $10,000 a month loan payments. And over the course of a 10, 11 month hold, in some cases, that payment can really eat into a borrower's liquidity. You're talking about $70,000 to $100,000 in loan payments during the life of the loan. Forget about down payment and closing costs. So having a lender like myself that can build in loan payments into the loan is a game changer for borrower and their liquidity, their ability to invest in more projects, call less capital from investors, you name it. Interest reserves can really be a game changer for borrowers. As real estate investors, we know that projects will get delayed. Sometimes permitting takes longer than we think. Sometimes contractors are backed up. Whatever the case may be, projects take longer than we think, which means you're going to end up paying more in carrying costs, more in interest carry. So having an interest reserve, even if it doesn't cover the full 12 months of payments, having any amount in the interest reserve can go a long way towards offsetting your interest carry. So oftentimes we'll build in interest reserves that'll be, say, $10,000, $15,000, and maybe that's half of the expected loan payments, but it's still an amount that we can fund by maximizing the LTV, putting the money into the interest reserve, using the interest reserve to fund as many loan payments as we can, and then the borrower takes over and makes loan payments from there. So it's a great, great tool. So what is an interest reserve? An interest reserve is an amount of money that's built into your loan that's used to make loan payments for as long as it can. So what will happen is on the first of the month, when a normal loan payment would be due, you would get a statement as a borrower that says the payment has been made on your behalf, drawn from the interest reserve, and then it will show you the amount remaining on the interest reserve. And what it will do is the interest reserve will pay that payment for as long as it can, at which time the borrower has to step in and start making payments. So a lot of the times interest reserves are expected to cover the full 12 months of payments. In other times, they're only expected to cover 6. So it really varies, but what it allows borrowers to do is to maximize the loan, to maximize the LTV, and to cover interest carry for as long as possible. What if I told you that experienced borrowers who come to me doing a fix and flip or a new build can build their loan payments into the loan and maximize their loan to value every single time? That's the power of an interest reserve. And that's the power of coming to me looking to maximize your liquidity and to go out and make as many investments as you can. So what are the downsides of having an interest reserve? And there really is only one that I can think of, and that's the fact that as a borrower, you're going to pay interest on that interest reserve day one. So you're paying interest on interest. So liquid borrowers borrowers who want to save a little extra money and don't want to pay interest on interest will choose to opt out of getting an interest reserve. And it's because it's a little bit different, right? A construction escrow that's sitting aside, we don't charge interest on that. We only charge interest on drawn funds. So that nuance between how we treat an interest reserve versus how we treat a construction escrow is something to consider as a borrower if you're super liquid. But to me, that's really the only major downside, I would say, in putting an interest reserve into play, aside from just increasing your leverage in general as a borrower. Some lenders may increase the interest rate by 25 basis points or 50 basis points for building in an interest reserve. So that's another potential cost associated with having an interest reserve in place and something to be aware of. And like anything else, it's a trade-off and something that should be modeled as to whether it works for you or not. But it definitely can add a little bit of interest carry to your projects depending on how long you plan to have the loan outstanding. Interest reserves aren't for everybody. Some people don't want the additional borrowing costs that can be associated with an interest reserve. But for those who are looking to maintain liquidity, to really smooth out their cash flows, to keep projects on time, or potentially to deal with projects that have been delayed, interest reserves are an amazing tool and one that you should reach out to me about if you have any questions, for sure. I'm glad to structure loans for you and work through the numbers. But as always, if you have any comments about interest reserves or anything else related to hard money loans, don't be shy, leave them in the comments. I'm quick to respond. And as always, thanks for watching. If you like my content, please like and subscribe as always. I look forward to the next one. Thank you.